Okay, so this is where we left off last class. I had explained, described the security market line. The major landmarks here are risk-free market, the risk measured by beta, measure of risk, and then the measure of return here on this axis. And I explained that all securities, all risky and risk-free, as well as all investment opportunities, fall on the security market line. And I described the adjustment should any asset be off the line. Okay, so that's what we left off doing. So now let's just apply, let's just price some assets with information. So if I give you risk, in other words, you can use the line to estimate the return, the expected return. That's what we're going to do with the line. So here's some examples. We have two stock. And these are their measures of risk. So use those to estimate the expected return. Can you guys do that? You're going to use the line. The line, remember, is this equation. So use the equation of the line. So there's some people getting their tests back. Do you want me to wait or? Okay, well, I'll give you guys a break. I think I think Gabriela organized everything so it's easier to get back to you. And so while we're waiting, if you can apply the equation to estimate the returns for stock A and stock B. Okay, and I stopped recording. All right, so here we are. You're at case part 2, and we're going to solve this in the second set of notes. I'm going to share my iPad again. Okay, and I was just saying that this is like our fourth method of estimating the required rate of return. We learned about the first method was just estimating the total dollar return, holding a stock or share in a company over time, over a period of time. We could calculate the capital gains yield plus the dividend yield to get a measure of return. We also learned about taking some assumptions and using the dividend growth model. Then I talked about using the GAR, right? The geometric average return and the standard deviation as a measure. And this is what we're going to end with. This is a method to calculate the required rate of return. And it is the capital asset pricing model. The capital asset pricing model comes with a number of assumptions, and to apply it, we assume those assumptions hold. And among those assumptions, one is that individual investors can borrow and lend at the same rate, which is a far stretch, like I mentioned last class, that really when you loan money, it's probably going to be less of a return than if you loan money, yeah, you're going to get less of a return, or sorry, you're going to pay an interest rate that's going to be higher than, no, I'm doing this backwards. When you loan money, like if you deposit into the bank, you're going to have an interest rate that's lower than if you borrow money and you have to pay it back. That's going to be higher, okay? But in the capital asset pricing model, we assume those rates of return are the same. We only assume there's one rate. And then when we apply, or we only, there's no bank other than operating with the interest rate from the T-bills to borrow and lend. And so I was saying that this has an E around it, but not around, there's an E around the return to S being the stock company, right? The return to stock in the company. And this is the risk-free rate, but there's no E around it. And there's no E around it because it's it's risk-free. So there's no volatility. No matter what happens, it remains the same, right? It doesn't change. So we don't put an E on it because there's no volatility. Um, so we have this data here. We're going to start, just like I did in the last exercise, we needed the beta or the measure of risk to get the return. So that's what we're going to do. We're going to feed in the beta and then estimate the expected rate of return. To get the beta, remember what is the beta? The beta is the slope. It is the slope with the market returns here and the stock returns here. And we imagine the slope of that, an estimated, the slope of the least squares prediction line would give us the beta. And how do we get the slope? What do we do to get the slope? Put it into your calculator. So you're going to use data and stat to get the answer. So let's try that.
Professor, I have a quick question.
Uh-huh.
In the calculator, when we are going to put the values for X, we put them as decimals, and for Y, we leave them as percentages.
No, just do decimals, everything decimals.
Everything decimals, okay.
Yeah, why? Because no, you always use decimals. Just keep it clear in your head that these are for returns and the beta is not a percentage. That's the main thing to remember. But
All
use
right.
all decimals. Just remember that fact. Okay, so let's enter this data in. Second data, and oh, there's something there, so I need to clear my work. And then I begin 0.0491, enter down, and then pair with zero point 0.1, enter down, 0.1579, enter down, with zero point 0.3, oops, my finger slipped. Okay, so I have 1 and 2, and now I got to put 0.3, enter down, and then this one 0.0549, 0.0549, enter down, and 10.1, enter down, and then 0.37 negative, enter down. Be careful with the negative. 0.55 negative, enter down, and 0.2646, enter down, and zero point 0.4, enter down, 0.1506, enter down, and zero point 0.3, enter down. Okay, and then let's double check. I got all the right numbers in there. And then stat. And the results, I'm going to scroll all the way to B. And there it is, 1.55. Now, the notes are a little bit different because I think I rounded all the steps because I did all the steps manually. But anyway, let's just do it to 2 decimal places and it's no different. So it's 1.55. So it's more risky. It's sensitive to market returns, right? Hopefully you guys remember all that. So everything I taught you at the beginning, we're going to apply it now. Beginning of Unit 5. So here we are. Oh, I think there was a slide down there. That's what I get to show you. It's supposed to be one slide a page, but it's not. Okay, so I did all the calculations here and rounded, and that's why it's a little bit different, but let's be happy with 1.55. Okay, so we have our wonderful calculators that do all this for us, but we still should know how to do this. You shouldn't forget, we spend a lot of time on that. We spend a few classes on that. Okay, so now, what do we need? What's next? What else do we need? So let's get our formula. Here, let's take it again. Okay, so we have computed with our calculator, we have the beta of the stock, UAir, and we actually got the expected return to the market. If it's on our calculator because the market was X, so X bar would be the expected return of the market, okay? So we have those two things. And let me put it a little bit lower. So all we need to estimate the expected return of U air, or the required rate of return, is our RF. All right, so it seems like it should be straightforward, but which RF do we use? This was a very different time, right? We all agree that it was a very volatile time for the stock market from 2007 to 2010. So what do we do? So this is, I'm going to propose, I guess, I think there's three different ways to do this. One is, let's take some data in and around, or like historical data before 2011, which is the current year. I should write that somewhere. So this is historical. So the current year is 2011. And I'm going to take the previous 6 years and I'm going to estimate the average T-bill. So the average T-bill, if you put these in your calculator or you just put them in stat mode or just add and divide them by 6, will be this. Okay, 2.365%. So it's lower than average in general, but in this period, that's the average. This is known as the average T-bill rate, and we get the average market return from our calculator from this data. That was 5.11, it turns out to be. And then we can talk about, we could take 5.11 and subtract 2.365, which we do here, and use that. Okay, so that's my first approach, is to do it that way. So this is a number one method. So that's what I'm going to do. So I put all that together in here using this 1.52. Okay, so I didn't round it to 1.55, but it's basically using the numbers that I estimated before. It's going to be similar anyways to what we got in our calculator. Just remember, this is a little bit different because to do this I had to do it this way, I had to round at some point, and it gave me a slightly different answer. All right, so it turns out when I add it all up that the expected return to UAir is 5.27. So this is the required rate of return using the capital asset pricing model and the average T-bill rate over the last 6 years. Another point to make is I didn't use the average T-bill rate here. So just notice that I'm going to put a little, I don't know if that's estrella, asterisk, put an asterisk on it. Oops. Okay. For that, to make this estimate, I don't use the average, I use the current. Because what I'm saying, remember the meaning of this, right? Investors today should invest in T-bills and they expect a markup over and above. This is their baseline, and they expect to invest in risky assets. They need to be compensated. To invest in UAIR, they should be compensated by the risk associated with UAIR. For every unit of that risk, they want the market risk premium. The market risk premium is going to be historical based on the last 6 years, but this, the markup, like where we're going to put a baseline, is the current T-bill rate. Okay, so them being different, we use the current T-bill rate. All right, so that's how we get this number. Now, I have to ask you if you guys remember what, in the UR case, was the required rate of return that I gave you to use. You want to look back at your notes, or do you remember the UR case? Well, I can, let's go look at the notes. I go back to the notes here. And what did it say here? Is it here? No, it's on your case part 1. Okay, so let's go back to unit 4 and let's see. What did I tell you to use? There it is, right here. You see? What does it say?
10%.
Yeah, so we use 10%, but what did we get just now? Let's go back. What did we just get? We got 5. All right, so the originally, right, the required rate of return was 10%, the discount rate that you were supposed to use, but now it's smaller. How does that change the decision? Originally it was 10% and we chose to invest. Right? Because why did we invest? Well, it turned out that the NPV was positive, but also the IRR was equal to 10.26, if you guys remember back. So this tells us that the IRR is bigger than the required rate for an investment project, so we invest. Are we going to make the same decision now? If the required rate of return is 5, this stays the same, right? The internal rate of return doesn't change. It's still 10.26, so we will still invest. Okay, so it's going to beat 10. If it beats 10, then it's going to beat 5. But we do feel a little bit uneasy that it's so low, right? So we want to do something to check. We're going to double check. We're going to check a different way. Let's see if we try more data. Let's grab more data and estimate the historical market risk premium using all that data. If you remember back when we began Unit 5, I was showing you this data for the S&P 500 over 1928 to 2010. And in there, the common stock return on average was 11.3%. T-bills average 3.7%. So look at this difference. So you see that calculation depends on what you put in. And if you put garbage in, you're going to get garbage out of your estimates. So you got to be careful and calculate it different ways. So I don't expect you to do all this on your own. Like I'm going to tell you what to use, right? But you should be aware, I could be wrong. I could be giving you bad inputs. And you should be aware that all the options to doing this, right? That there's alternative ways. All right, so Now it's 7.6%. It was 2% the first time I did it. So we're going to call this number 2 method using the full range of years that we have in the stock market. And we're still going to use the current T-bill rate of 1%. We're going to use the same beta, but we're going to use the historical market risk premium over 1928 to 2010, which is much larger. And that results in a much higher required rate of return. Now, if we use this number, does it change our decision to invest? It will, because remember, the IRR of U Air was equal to 10.26%. So this 10.26% does not beat the required rate of return. So now we have to make an executive decision. We have different findings using different inputs. So what should we do? This is very different than if you use the last 6 years of T-bill data. This required rate of return makes it less likely that the project will be accepted. When these are different, the convention is to use the more current data for a robust or reliable estimate of the cost of equity, okay? Okay. So that's the second way to use more data, but then we threw that way out and we still feel uneasy about going from 10% to 5%. So let's try one more way. So this is my third attempt at estimating. I'm going to use the dividend growth model. How do I do that? I need information on dividends, and you'll see in the UR case part 2, I gave that to you. So there's the dividends there. We're going to assume constant growth over this period. And estimate G. So what that entails is to take the 2005 dividend, grow it for 6 years, assuming G is constant, and then solve for it. So after 6 years, 1, 2, 3, 4, 5, 6, it should take you to this. So we're going to fix those and estimate G. In estimating G, you guys can check the math later. This is the growth rate. So the growth rate is almost 4% a year. Then I'm going to use that to estimate for the following year, 2012. So it's gone from 20-cent dividend per share to 26 cents. I have to do this because remember what the dividend growth model is. The dividend growth model is this formula. I need to have G, I need the next dividend, and I need the current price. So this is all given. Okay, this has to be given. We solve for this, so this is like given. This is going to be our G. This one is going to be our price. And then what's missing? C1. C1 we calculate. C1 is this. Like, it's not exactly given, you have to calculate it, but it's given. Oops, that was not smart. Oh, I didn't want to get rid of that. What did I write? There. Just wanted to erase this. Not really clear what that says. Okay. Put it all in, check this later, make sure you can get this. And now the required rate of return is that. So how interesting that now my number for using the dividend growth model, estimate number 3, is much more similar to estimate number 1. And it will lead to the original decision, doesn't affect the decision to invest or not. So I feel more comfortable with that than going to 12% with all this data. So I'm going to stay with the original capital asset pricing model result of 5.0 let's see, what was it? 5.27? 5.27. All right, so let's see. With that result, um, here's the data. So you got to go back to remember the data, but this is the data from UAir. And this is the total project cash flow. So this is how you can prepare the cash flows like we did in class or in the videos. I explained that you can derive these cash flows and then you could calculate the NPV or just calculate the IRR and see that this project still says to invest. IRR we already had, so I did it without having to have this page. So what are the assumptions of doing this? We assume UAir is an all equity firm. Okay, so in other words, they issue stock but not bonds. We're going to deal with bonds in a moment. And we also assume that the Bahamas project is no different than the other operations of UAir. If it was, then we would need specific inputs about Bahamas-like projects to evaluate that. In other words, we need special information that we just don't have. So we just use the information on UAir in general. Okay, so we're going to talk about that a little bit, relaxing this assumption in a moment. Okay, so that's the result. So all this work, all that you learned in Unit 5, just to come back to Unit 4 with a better measure or estimate of the discount rate. That's all we've done. So the decision is to invest, and this is what it looks like, putting it, let's cast it in terms of the security market line. Remember, I told you that this line has all stocks, bonds are on here, all combinations of the market portfolio and the risk-free rate are on here. Also, all investment projects fall here, right? So this opportunity that we have actually plots up here. Here is the expected return. It's 5.27 that we calculated. It would be on the line because we used the capital asset pricing model to find it. But it turns out, given the cash flow estimates, that UAir is up here. And what do we do with assets above the line? What did we learn last class? We buy and hold them. Okay, we long them. Take a long position. So similarly with investment projects, go for it, right? Invest. It's worth it. All right. So just notice some of the notation is a little different, but it's the same, cast in terms of the U air. It's not going to just be S, it's U air. So I replace that. And also that I use the average, the weighted average, not a weighted average, sorry, the arithmetic average to get those. And to get this exact number, I use just the last 6 years. Okay. All right. So now what? Okay. So now what we're going to talk about um, is what if? What if the firm is not all equity? What if they also issue debt? So they not only have shareholders or partners, they actually take on or borrow money. Okay, so from investors, they've borrowed money and issued bonds, and they owe investors an interest payment. And so that has to be paid before shareholders who are residual claimants, before they are getting their dividend, right? So there's a tension between bondholders and debt holders. And some people are both, right? Some investors or some institutions invest in both in a company. But you can talk about them as shareholders and bondholders or the average investor. So they are residual claimants. These guys are paid first. And because of the balance sheet, we understand that assets of the firm, what the firm owns, is equivalent to what they owe investors. V stands for the value of the firm. The value of the firm, total value of assets, is equal to S plus B. So S here and B here are the total value of outstanding stock. So it's the market value of stock and the market value of bonds. I think I have that on the next page. You guys can read what I'm writing. So my pen is too thick. Okay. So I do a lot to explain that here. All right, so I just repeated here a million times, no, well, several times, and I use this notation. So so we have stockholders, we have bondholders, and we have something I refer to as the average investor. So they're partly invested in stocks and partly invested in bonds, and they're invested in a way equivalent to the fraction of equity and debt in the balance sheet. Okay, so what does that all mean? So here's my notation. There's S's, RS is the equity, BS, beta S is the debt. Same here. Okay, so bonds also have a return to debt and a beta of debt. And V is the market value of the assets of the firm, and we can write R of assets and beta of assets. All of this can be plotted on the security market line, just like I did A and B earlier. Okay, if you guys remember. So let's talk about the share, okay, that proportion. If a firm is all equity, then the share of stock is 100%. So it's all stock firm. And like zero debt. That's pretty clear. If a firm is all debt, so there could be no shareholders, just bondholders financing, then it's 100% debt and no equity. So these fractions, it's just like S as a fraction of the total assets, okay? The market value of firm's assets. But then there's shareholders, there's bondholders. If the firm is all stock or all equity, then you only have shareholders. If the firm is all debt, you only have bondholders. But if a firm is leveraged, in other words, it issues debt, that just means issues debt. Then we refer to the investors in the firm as average investors. They're forced to be both partly bond and shareholders, but in the proportions that the firm holds debt and equity shares outstanding. All right, so I'm just repeating myself, trying to get to the point here that we have three players here. We have the stockholders, the bondholders, and you have the average investors that are part shareholder and bondholder. So if a firm okay, um so I mentioned this earlier. So S is the market value of outstanding stock, where RS is the return to shareholders. So for every dollar invested, this is their expected return. Notice I haven't put the E on here. So I just dropped the E. Okay, so we're just using RS. So don't get confused. E of RS is the same as RS here. And B is the market value of outstanding debt, where RB is the return to bondholders. So for every dollar invested, this is what bondholders get. So these are all interest rates. These are rates of return. Where the value of the firm is the value, the market value of the firm's assets, we will refer to our assets as the return to the average investor in the firm. Okay. If a firm is all equity, then there's only stock outstanding, so our assets is just the return to shareholders. If a firm is all debt, then you only have bondholders, then our assets is just going to be the return to bonds. This is your interest rate for bonds. If a firm is levered, so you have both stocks and bonds, so a mix, then the return to assets we're going to refer to as RWAC. WAC stands for the weighted average cost of capital. That's what it stands for. Weighted average cost of capital. WAC. Okay. In other words, it's the cost of capital. So we can call, you'll hear this is called the cost of equity. And that's what the name of this set of notes is, I think. Cost of equity. This is called the cost of debt, RB. And this is called, because it's a little bit of both, it's the cost of capital. So these are the investors in the firm. They've offered up capital, money, that the firm gets to use to grow or operate. Okay. And there it is. Okay, so that's all the setup. Now let's see what we do with it. So here's what we do with that information. What happens is we have to calculate, just like we did earlier, that the weighted average of returns gives you a return. If you combine assets into a portfolio, remember, the expected return is the weighted average. All the E's are gone here. There's no more E's here, but this is just like X1E R1 plus X2E R2. Is that messy? Let me do that again. Get a finer pen. So you remember this, right? That's all this is. That's all this is saying. But there's many, because you can have many different assets. So this is just for two, but you could have many. And then, so this is the formula for that. It's the same thing. So we just have two assets or two securities, right? We have the stocks and the bonds. So we're going to weigh them together. This is the weight. Unfortunately, I'm putting it here rather than in front, but that's the way it is. So this is the weight. This is like the X1. So this is like the X1, and this is like the X2, the weights in green. And the returns are the stock, return to stockholders, and the return to bondholders. The only thing that might be strange is this. What is this all about, you might ask? What is this? Well, the fact is, and this is why, even though there's a tension between shareholders and bondholders, because shareholders they would prefer to get all the profits, right? But then bondholders have to be paid first before shareholders realize their profits. But they think to themselves that, hey, wait a second, there's a benefit to debt. Paying debt holders their interest payment, that interest payment is tax deductible. Okay, it's tax deductible. So just like we worked with the capital budgeting, and we talked about depreciation, right? That's a cost or a loss that was tax deductible, and that was seen as giving us a positive cash flow. So there are benefits to being able to apply that, and it's a feature of the tax code. And similarly, this is a benefit to corporations that they can expense interest payments to bondholders. And so we have this extra term because even though this is for every dollar invested, bondholders will get RB, but from the firm perspective, they get to they get to benefit from reducing their taxable income as a result. So I do some math here to show where this RB1TC comes from, but it's basically, let's go through the steps here and show you that the firm pays bondholders interest payments for of RB for every dollar invested. However, the firm also incurs tax savings of the tax rate times RB for every dollar invested. So it's going to be, so if you remember, we had TC, it was TCD, right? Now it's going to be TCRB. We worked with depreciation. So if you take this RB, which is the payment, but then we offset it by TCRB that we save, this is the net result. So that's what this term is here, okay? So it's a little bit lower. It's not just RB, this is a smaller number as a result because TC is always a number less than 1. This will never be negative. All right, so let's use this now. Let's talk about you are actually being a levered firm. It actually issues debt. And that information is provided in the case. There's just some mention here also. Remember, just like I can do the weighted return, I can do the weighted beta. Okay, so this is a weighted beta to calculate the beta, the risk of that portfolio. And I just make a point here of showing that you'll see that the beta of stock is definitely, well, stock is more risky than bonds, right? So beta of S is always bigger. Beta of bonds will be closer to 0, relatively speaking. So if I just made that 0, so close to 0, this is a fraction yet of a number that's close to 0. So that just leaves this amount. And it demonstrates here, if you just do the math, and I solve for the beta of equity, the beta of equity is going to be more than the beta of total assets. Okay, so what is this saying? It's saying that just like um, when we combine, let me go back to that because I think it's best set over here. So this is what we did at the beginning of the class where we plotted A and B. It's basically saying if you have A and B, P will end up between them. All right. And in our case, we have equity higher up the SML than debt. So debt weighs down the cost of equity, or cost of capital. That's what's going to happen. All right, so let's apply. There's just a few examples here before we go. So this is all given to you in the case, in the UR case, part 2. So here we have the formula. I just copied it. You guys should put that on your formula sheet. And you're given all this information. This one you calculate for UR. So this one we already did, right? This is the cap M. That number should look familiar right now. So that's from the cap M. This is the weight. Where did I get this number from? This is given. If you read the case, this is given to you. So that's the share of total assets that are stocks. And then this is the share of total assets that are debt. And then RB is given. So they're told that UR issues a bond with 6.04% rate of return or yield to maturity, and you put it there. And then the interest, sorry, and then, so this is given. So all these things are given. You just got to put it together. And then the tax rate. Remember, TC represents the corporate tax rate. And put it all together, and we get a new required rate of return. So this is going to be this is number 4. So this is the 4th estimate of the CAPM for the firm, and this is the levered firm. So we use the all equity result to get the result for the firm with debt. Any questions? Are you guys dying? Are you guys okay? Honestly, this is not hard. You just gotta practice. And then here, I can use that now. It's now 4%. It's smaller. The main point is that this goes down. This went down from 5% down to 4% because this, when you're weighing between them, like I showed you, you go somewhere in between. This is the higher one. Equity, the debt is lower down the SML, and then you end up somewhere in between, and that's why it's 4.49%. And then applying it, you're still going to invest. Okay, so if you invest at 10%, then you're going to invest at 5%, you're still going to invest at 4%. Okay, some other statements here, just a couple more slides. Okay, so what if the firm and the project have different betas? It could be that the Bahamas is a more risky venture than the other more predictable, or it's you're just more sure about the other operations of the firm, but let's say that the Bahamas project just is much more volatile. Okay. So when the project and the firm are not from the same line of business, so let's say the Bahamas project is just so different from the other kinds of things they do. I mean, it could be the case. And in general, this is just for an example, but in general, whatever project you're looking at is beyond what the firm is used to doing. So let's say it's a firm that works in manufacturing. They decide to deliver some some product, right? And they've never done that before. So that project would be distinct from what the firm usually does, manufacturing. So what you should do is go into the industry and look for a beta in that new industry. So if it's transport, logistics, try and find a beta that's going to, be more realistic for your project, and you should use that instead. This is going to be hard, however, for operations or for firms that don't have an industry per se. They're so different, right? It's going to be hard to find a historic beta. When the project's risk is inherently different, even if in the same industry, you're going to have to change this, right? You're not going to use UAIR's beta. Let's just assume for a moment the Bahamas project is more risky than the other operations of UAIR. And let's say we find that we should use a 5.5 beta. It's huge, but let's just put that in there and see how that changes things. So now, mathematically, using the same from our first estimate, with the current T-bill rate, and then this is the 6-year market risk premium, we get an expected return of 16.28%. So that's really high. Okay, so if we have that, and then we got to recalculate the WACC because we have also the debt, we recalculate everything, and this brings us back to a number that we're familiar with, like around 10%, but it is too high. Okay, it is too high, and too high in the sense that the cash flows gave us, remember, an IRR of 10.26. So now, with all the considerations and the riskier Bahamas project accounted for, we would reject the UAIR project. So all of this information leads to different information leads to different findings in this case. So this is going to be my number 5 estimate. Okay, and I just make a point that if you have low, so yeah, we won't invest. So just follow the instructions on the documents you're studying from. If I ask you to calculate the NPV or just determine if you should invest, using the IRR will give you the correct answer anyway. So I just wrote this into the notes to say that, the T-bill rate had been low from 2010 to 2000 and 2015, 16. It was like just, well, no, even the 20s, right? 2020, it was really low. 10 to 20, 10 years of low T-bill rates. And what is the effect of low T-bill rates? If you go back to the UAIR, sorry, you go back to the formula for a capital asset pricing model. If this is low, it keeps the expected required rate of return low, and you're more likely to invest. So keeping T-bill rates low can be, or has been, it's a stimulant to investment, right? And so just I put that, it can be it can have the effect of stimulating the economy because it promotes investment. All right, and that's it. This is just an example here of, I could give you 3. A firm could issue stocks or common stocks, it can issue debt, and it can issue preferred stock. So preferred stock, different from common stock, does provide like a guaranteed return. We talk about common stock and that it doesn't, it's more risky than debt because there's no commitment to give you a dividend, or there's no promise that it's going to rise in value. So the return um, is not guaranteed, right? This is just expected return. Well, with the return on preferred stock, there is a commitment to pay you a return. It's going to be higher than the bond rate, but there are some terms of preferred stock. In fact, some firms, if they offer preferred stock, stockholders are not able to vote. in annual general meetings. So there's always a downside. There's a trade-off. That's what I'm looking for, expression. All right, so here you have, because you have three, now the value of the firm is made up of outstanding stock, bonds, and preferred stock. Okay, somebody has their volume up. All right, guys, I'm going to I'm going to stop there and let you go. And I'm going to be available. Some people asked for me to be available tomorrow to answer questions. So I will come on to Zoom at 1 o'clock tomorrow, and I will stay with Zoom open tomorrow until, I don't know, 5 o'clock. I'll send an email about it. I'm trying to put my camera on. Sorry. All right. So if you need to see me, I'll write you an email about it. Do you guys have any questions for me? The test. Oh, the test is going to be in, we got the room, Osuna 221 and Osuna 222. I'll ask for you guys to be in 221 because you like it so much, right? And I'll send an email about that too. Any questions for me? I'll see you tomorrow on Zoom for office hours, 1 till 5.
Is the test going to include um the whole of Unit 6?
Oh, Unit 6 is just self-study. You guys are supposed to just
Okay.
like study that yourself. There's only going to be a couple of questions of it. And like I said,
Okay.
that you have to answer 8 questions out of 18. You only have to answer 8. So do what you will with that information.
All right. Thank you. I was just curious. I was just kind of just wondering because since we didn't really go over a lot of it, I was just wondering
Unit 6
okay.
is for you guys to study. I was never planning to study Unit 6. You mean Unit 5? Are you talking about Unit 5?
Uh
Unit 6 was always
yeah, I
self-study.
think you know what? Yeah, I think I was talking about Unit 5.
No, Unit 5
Um
is all of it. You guys have to be able to do all of it. You guys got to study. I told you from 6 weeks ago, you guys got to work ahead, study. You have all the questions there. See me tomorrow if you need help.
yeah, okay.
Okay. Are you home,
Thank
Derlin?
you. Oh yeah, I'm home. Had a bunch of issues with the internet and everything, but I'm home.
Okay, well, I recorded this, but you should probably go through the recordings that are already there. Those are even better than this. Okay.
Yeah.
So keep
Yeah, I was planning on doing that because like there are certain things that I just need to refresh on it on like
you have to
from the
practice.
first time.
Sit and practice those documents. That's the most important thing. All this instruction is, yeah, it's all there, but you got to solve the problems in the end. So you got to practice the problems.
Right, yeah. The reviews and everything.
The extras, yeah, the documents. Review the documents without looking at the answers first. Okay.
All right.
Okay, everybody. I'm gonna close up. See you tomorrow if you need help. 1 o'clock. Zoom.
Bye, Professor.
Bye.
Thank you.
Thank you, Nalim.
I have a
Daphne 1.
question.
Yes, yeah. Uh-huh.
How are you?
Am I? I'm
Yeah,
I'm
good,
okay. I'm okay.
good, good.
Yeah.
Um, I wrote you an email por los office hours, pero lo dijiste que we're gonna be at 1. So,
Yeah, you can come. I'll be there. I'll have my phone on 1 till 5.
okay.
So we can,
Te iba
whenever
a
you come.
preguntar, we spoke about the quizzes. I couldn't go to the to class to pick up the los quizzes porque estaba en el Capitolio ahora mismo. Um, and
Gabriella's
I
in the lab, or she's coming
she's
there
still
now.
she's gonna. Oh, she's going there? Okay.
She's between the lab
Ah,
and
okay.
there. Like she's like in both. She keeps going back
Ah,
and
pues.
forth. So find her. Here, I'll give you her number if you can't find her. Well, anyway, try and find her. If you can't find her, I'll email you her number, okay?
Okay. Y
Okay,
te iba a
bye.
preguntar if
Uh-huh.
I know we spoke about the quizzes y me dijiste como que por las veces que he faltado, eh,
We can
que
work
if
with
I
it next
saw
week, Yasiel. Don't worry now. We'll work
next
with it
week.
next week if you need it.
Okay.
Yeah, we'll
Okay,
work
pues
right
perfect.
now, just focus on the test, on the exam.
Okay. Ah,
Okay,
pues
we'll
super.
talk next week about it. Okay,
Super. Thank
bye.
you. You have
Bye.
a good one.
You
See
too.
you.
Bye.